Good afternoon, guys. So yesterday we covered like the basics of what are calls, what are puts, and the basic terminologies that those are used in the market. And in today's webinar, we'll try to cover the basic strategies which are like commonly used in the market. Okay. So we stopped over here, like what are option buyers, what are option sellers, strike price, expiration month, and expiration date. So this is where we stopped yesterday, and we will continue from here. And in today's webinar, as I told, that we will be covering a lot of strategies, like a basic strategies which is commonly used in the market. Okay. So now the first strategy, that is like what is a call? This is a very common strategy that is used in the market. Now it says, what is your view on the market? Suppose if I'm bullish on the market, I will simply go ahead and buy a call. This is a very absolute basic strategy. Like I feel that the markets are going to go up. I'm bullish on the market, and so I'll go ahead and buy a call. Now what needs to be done? Buy a call option. Strategy implementation. When an individual feels that the markets will go up, what is the upside potential? The upside potential is unlimited as market rises. What is the downside potential? Limited to the premium paid. As I told you guys yesterday, that in case if you are an option buyer, the maximum loss you can incur is the premium paid. So in this case, irrespective of the stock going anywhere on the downside, the maximum loss you can incur is the premium paid. So that's the reason the downside potential is limited to the premium paid, right? What is the cost of premium? Now, higher the strike price from the current market price, lower the premium. Now I'll explain you what does it mean here. Now suppose if I feel that the markets are going to go up, I'm sorry, this is like upside down. So, but I feel that from 130, I think that the market will go up from 130 to probably say 160 or 150 levels. So what I'll do is I'll simply go ahead and buy a 130 call option, wherein I'll spend a premium of 10 rupees, right? So the position is, I feel that the markets are going to go up, so I will go ahead and buy a call option, right? And I buy 130 ka strike price ka call, and I pay a premium of 10 rupees. Now remember again one thing, when you are a buyer of an option, the maximum loss you can incur is the premium paid. So in this case, irrespective of markets falling anywhere, suppose if your view goes wrong and the stock comes to say probably 100 rupees, right? So suppose if you had not bought a call and you just had taken a long positions in futures, then probably you would have incurred a loss of 30 rupees, right? But because you are a buyer of a call option and you spend just 10 rupees, the maximum loss you can incur is just 10 rupees, right? Now the stock rises and it goes to say 160 rupees. What would be my payoff? My payoff would be, I have spent 10 rupees to buy this 130 strike price per call, and the stock goes to 160. That means the difference between these two strike prices, that is 160 and 130. So 30 is the difference. So the call premium at 160 of 130 ka strike price per call would be 30 rupees. But I have spent 10 rupees to buy this call. So 30 minus 10. This is how this came 20, right? With every incremental of 10 rupees, the profits will increase by 10 rupees. So this is what it means by buying a call. So this is just a naked call buy, wherein you will just go ahead and buy a call option. In case the stock rises, it will your profits keeps increasing after your break-even point. Over here, the break-even point would be 130 plus 10 rupees. That is 140 is your break-even point. Above 140, with every incremental in 1 rupee, your profits will increase by 1 rupee. Okay. And in case if the stock falls at whatever levels, say 100, 90, 80, or probably 10 rupees, the maximum loss you will incur is just 10 rupees. You are a buyer of an option, and by definition itself, it says when I'm a buyer of an option, the maximum loss I can incur is the premium paid. In this case, I've paid 10 rupees, so my loss can only and only be 10 rupees. So this is what it means by the highest of the strike price from the current market price, lower the premium. Now I'll explain this. Uh, so this is what it means by downside potential is limited to the premium paid, right? Now, the higher the strike price from the current market price, lower the premium. As you go outside the strike price, as I explained you yesterday, this is your ATM, that is current market price is your ATM strike price. This would be your OTM strike price, that is out of the money. And the outer you go, lesser the premium. So in case if this is 10 rupees, this would be probably say 8 rupees. This would be probably 5 rupees or probably 4 rupees. Then if you go above, like out deep out of the money, say 200, then probably this would be say 2 rupees, right? So this is what it means by the higher the strike price from the current market price, lower the premium, right? What is your break even point? Break even point in terms of call is strike price plus premium. So this is your strike price 130 ka call, you spend 10 rupees. What is your upper break even? 130 plus 10, that is 140 ka strike price is your break even point, right? Above 140, whatever stock rises to whatever levels, you will start increase, like your profits increase incremental by every 10 by every like rise in 10 rupee, your profits will increase by 10 rupee. Note, if the market moves only a little, then the value of the option will decrease due to time theta decay. Now there is a like when you are an option buyer, the only risk attached to your option premium is there is a time theta decay that is attached to your option premium. So this is the biggest risk that option buyers carry with them, that the time theta decay. With every day, every passage of day, there is a decay in the option price, and as and when the stock nears expiry, or like literally say the time value keeps decreasing. So this is what it means by if the market moves a little, then the value of the option will decrease due to time theta decay. Okay, so this is a basic strategy. Long, it was a long call. Sorry. Now I'll go to long put. So first view was I'm bullish on the market. Now second would be I'm bearish on the market. So I feel that the markets are going to go down, and I will go ahead and buy a put option, right? So as I said, my view is bearish. I'm expecting the markets to come down. So I will go ahead and buy 130 ka strike price ka put option, right? I will buy a put option. Okay. So I buy 130 ka strike price ka put option. My view is that the stock is going to go down. And in case if the stock goes down, I go right. Then I will start making profit. On the downside, as my view is bearish, on the downside, my break even is 130 plus 10 rupee. Sorry, less 10 rupee. That is 120. After 120, I will start making profit. So this is exactly reverse to what is calls. Calls, I'm expecting the markets to go up, whereas put, I'm expecting the markets to come down. Okay. In both the case, I'm a buyer of an option. And again, by definition, when I'm a buyer of an option, the maximum loss can be only 10 rupees in this case as well. So if I buy, say, 130 ka strike price ka put option by spending 10 rupees, my break even is 10 rupees, like 120 is my break even. Below 120, I will, like whatever levels it goes, say every fall by 10 rupees, I will start increasing. My profits will increase by 10 rupees. Over here, I've given example. So 130 strike price I bought by spending 10 rupees. Now suppose if the stock goes to 100 rupees, the premium of 130 ka put would be 30 rupees. I've spent 10 rupees, so my profit and loss would be 20 rupees. Now over here you can see I go wrong, and markets in terms of going down, it has come up, right? So it goes to 160 level. So in spite of the stock going to 160, I will still incur a loss of only 10 rupees. Why? Because I'm a buyer of an option. So here, what is my view? My view is bearish. I'm bearish on the market. what needs to be done? Buy a put option. Simple. Strategy implementation, when an individual thinks that the markets will come down, what is my upside potential? Unlimited as market falls. In calls, it was market rise, but in puts, because I'm buying a put, if market falls, then I'll make a profit, right? What is my downside potential? Limited to the premium paid. Cost of premium, the lower the strike price from the current market price, lower the premium. So this thing remains the same, that you go out of the money strike price for each call and put, the premiums keeps decreasing, right? Break even strike price plus premium is the same. If the market moves a little, again, because you are a buyer of an option, the risk of theta decay is attached to your option premium. So these are the most common used strategies in the market. The third one is a covered call strategy. Trust me, this strategy can be implemented for the people who have stocks in their portfolio, who want to keep the stock for ages, don't want to sell till certain levels. So what I mean by that is, say for example, Reliance is trading at say 1800 rupees or so, and you feel that probably in this month Reliance is not going to go till 2200. So a strategy can be done wherein you can earn little bit extra on the portfolio. So, but keep in mind, this is the most important thing. When you do one lot of selling a call, you should have equivalent of stock in your portfolio. What I mean by that is, suppose if Reliance the lot size is 250, you need to have 250 shares in your demat account. So that is how you can do this covered call strategy. And this strategy can be done like for the people who want to keep their portfolio for ages. If they are okay, if the stock comes down, like they are not worried, because they are a long-term investor and they feel that probably like I want to earn a little bit extra on my stock. So this is the best strategy for those people. Okay? This is called covered call strategy. Now, view on the market, range bound or mildly bearish. I'll give you. Yeah. So if suppose current market price is say 1060, okay, and probably you sell 1120 ka call, okay. So this is your position. Currently the stock is trading at say 1060, and you are selling 1120 ka call, and you receive a premium of 20 rupees, okay. Now suppose if the stock from 1060 falls to say 1000, as I told you, you are a long term investor, you will not do anything, so you will just see that your 60 rupees is going and you will do nothing. But in this case, suppose if you have shorted 1120 ka call, you will make a profit of 20 rupees. The only thing is, if the stock comes to 1120, you should be mentally prepared that I'm okay to give my delivery. I'm okay, like if I can release my delivery. If you can do that, trust me, this is the biggest strategy which will give you super results. Like, only the thing is, you should be mentally prepared that at these particular, at one level, I'm mentally prepared to release my delivery. Okay, so I'll explain you this. How does it work? Suppose if you buy 1060 ka, if you have the underline at 1060 and you sell 1120 ka call, okay, this is your position. Okay, now what happens? Three scenario can happen. Either the stock will come down, either it will go up, or stay at current market price. Now I'll explain you all the three scenarios. What will happen? Now suppose that this is the position 1060 pe, you have taken an underline and you have shorted 1120 ka call, and you got a premium of 20 rupees. Okay? Actually, I've taken 1060 ka, I've shorted 20 rupees. This is the strike price which I have shorted. 20 rupees I got, and short call, so I got a premium of 20 rupees. Now suppose if the stock expires exactly at 1060, then what will happen? Uh, you will earn nothing on the underline, because the stock was at 1060 on the start of the month, and the stock has expired exactly, or the expiry happened on the 20, as I told you, last Thursday is the expiry, and the expiry happens at exactly 1060. So what will happen? You will earn nothing in your portfolio. However, because you have shorted 20 rupees ka premium, you will simply fetch that premium. So the profit would be 20 rupees. So you will start the month positive 20 in FNO. However, your stock would be 0, right? Now at different levels, what will happen? Suppose if the stock goes to 1040, as I told you, you are an investor, you are okay if the stock goes down. I'll just see whether the stock decaying, and I can like just say, oh, like the stock is going down, but I've not done anything. But in this case, what will happen? Because you have shorted 1060 ka call, you will make 20 rupees ka profit. So your break even ideally has come down from 1060 to say 1040 because you have earned 20 rupees premium, right? So in the stock, see over here, stock will lose 20 rupees, but net P&L would be 0. Why 0? Because you have earned this 20 rupees in the options, right? And 1020, again, you received the premium of 20 rupees. You have shorted a call. You got a premium of 20. In the stock, you will make a loss of 40 rupees. However, your net loss would be only 20 rupees because you have earned 20 rupees by shorting a call option, right? So this is how this strategy can be worked out. You can do out of, like, suppose if you have good quality stocks in your portfolio, you can create a limit against those portfolio. And in HDFC, we don't charge any interest for such kind of positions. So you can literally use your shares as collateral. After haircut, say if you have 10 lakhs ka stock in your portfolio, and exchange says that probably there is a haircut which is applicable of 20%. So you just like after 20%, so 8 lakh a limit you will get. And at HDFC, like at 8 lakh you can create a position. You can go ahead and short probably out of the money call options, and we don't charge any interest on such positions. So this is the best thing with SDRs. So you get a limit, artificial limit. You can use those limits. You don't have a single cash in your account. You don't need to have single cash in your account. You can just go ahead and create a limit against such collaterals, and you can take a position. So this is how covered call works. Trust me, guys. This is a superb strategy for the people who wants to keep their stock for ages, and they are mental. The most important thing that you are mentally prepared at certain level, like probably 5%, 7%, or 10% above your current market price. You are mentally prepared that I'm okay to give my delivery. Then this is the best strategy to be done for. Now, range bound or mildly bearish, what needs to be done? Hold the stock and sell a call. An investor holds the stock, and if is of the view that the stock will not rise in near future, or the stock would be in range bound. An extra income can be earned by selling a call option. Now I showed you can earn a little bit extra, that is 20 rupees on your portfolio. Strategy implementation: call options are sold. The number of call options would be determined by the investor market view and the size of the stock he holds. So it cannot happen that probably you have, say, 100 shares in your portfolio and you're selling one lot whose lot size is 250. It should always match the stock and your FNO lot size. The both should always match. Now, what is the upside potential? Limited. Why limited? Because you are selling a call of, say, in of 1060. When the suppose if the current, this is not the current market price. Suppose if the current market price is 1000, you should be mentally prepared that I'm okay if the stock reaches to 1060. I'm okay to give my delivery. So this is the best strategy for those people. Why? Because after this 1060 become of 20 rupees, so your upper break even would be 1080. This would be your break even point. So after break even point, your stock and your profit and loss would be same. So below 1080 is okay, but above 1080, your stock, whatever stock will rise by every 1 rupee, this option price will also rise. And because you are a seller of an option, this is your break even point on the upside, that is 1080. So by selling calls, the investor is writing off the potential profit of the stock position. Maximum profit can be the strike minus the market price plus premium received. This is what I mean. Like after 1080, if in case stock rises to say 1100, but you will not gain profit for 10 to 20 rupees. Your profit will be locked at 1080 levels. So that's the reason this strategy should be done, keeping a view that you can do this strategy for probably say 8 or 10% out of the money calls. Downside risk larger, similar to that to that incurred with ordinary stock ownership, only offset partially by selling options, right? And because you receive a premium. Also opportunity loss if the market rises significantly. So in case if the market rises like continuously continues to rise, then yes, it's a problem. So there are two options: either you square off your call options and probably you sell out of the money ka strike price, else you just square off the positions at these levels. So the upside potential is capped to 1080. No, this strategy can be done for clients who want to keep the stock for ages and does not intend to sell in near future and wants to earn little bit extra on the portfolio. So this is the covered call strategy. Now you would have heard a word like straddle or a strangle. The major difference between a straddle and a strangle is straddle is you buy same strike a call or a put. Okay, it's a combination of call and put. So you buy same strike a call and put, that is called a straddle, and you buy different strike a call and put, that is called strangle. So that's the only difference. Otherwise, rest all remain, the features remain the same. The only difference is again straddle, same strike, triangle, different strike. Now, what is a long straddle? Long straddle means I don't know which direction the markets will go, but however, I'm expecting the volatility to increase. Like in current scenario, I'm expecting the markets to volatility. I'm expecting the markets to move in either direction. I don't know which direction it's going to go to, but yeah, that is one thing for sure, that I'm expecting the markets to move in either direction. So my bias is like neutral. Okay, so what I'll do is I'll go ahead and buy, probably say I'm saying that probably markets are although markets are trading at 10,300, say I'll give you an example. Suppose if markets are trading at 8,200, okay, so I will buy 8,200 ka call as well as put, and my total premium paid is 400 rupees. So what I have done, I have bought 8,200 ka call, CE is call, PE is put. So I bought 82 ka call put, I spent 400 rupees. Why I've done this? Because I'm neutral on the market. I don't know which direction the market is going to go to, but I'm one thing for sure, that markets are going to move in either direction. So that's the reason I have done this strategy. It's called a long straddle, wherein I buy same strike. You see, I'm buying a same strike, that is ATM ka call and put. Markets are trading at 80 and 8,200, so I'm buying 8,200 ka call and put. I spend 400 rupees. The moment I spend 400 rupees, my break-even points would be 8,200 plus 400, that is 8,600 on the upside, and 8,200 less 400 on the downside. So these are my break-even points. As I told you, my view is neutral. I don't know which direction the markets are going to go to. So that's the reason I'm doing this strategy. Okay. And suppose if I go right and there is a drastic movement in the market, say probably it comes to say 8,700 or 8,800 or 8,900. So once the market moves above 8,600, those are the levels at which my profits will start. Now over here you can see 82 and I've spent 400, right? So 8,600, above 8,600 you can see 8,700, I'll start making 100 rupees. With every incremental in 100 rupees, my profits will increase by 100 rupees, right? At the same time, in case if the markets fall after 7,800, how 7,800? 8,200 less 400, that is 7,800, 7,800. So this is my break-even point on the downside, and this is my break-even point on the upside. So after 7800, my profits will start increasing. So you can see at both the and in both the directions, the criteria is the markets to move above 400 ka range. So my view is like neutral. Above like below, sorry, 7800, my profits will start increasing by 100 rupees because my puts will start increasing, right? So at 70, suppose if the market expires at 7700, I will make a profit of 100 rupees. 76 200, 75 300. It goes to whatever levels. If my profits starts increasing by 100 rupees, right? So this is a straddle. Here, you want the market neutral with an increase in volatility. What needs to be done? Buy a call and a put of the same strike price. Strategy implementation, usually at the money call and puts are bought with the same strike price. My upside potential is unlimited. Why unlimited? With every incremental incremental of 100 rupees, my profits will start increasing by 100 rupees. Every fall by 100 rupees, my profits will again start increasing by 100 rupees, right? So upside potential unlimited, downside risk limited to the premium paid. Now the risk is in case if the stock expires anywhere, this is my danger zone, like 8600 and 1700 800. This is my danger zone. In case if the stock expires in between these levels, then I'll be in trouble. Why I'll be in trouble? Because I'm a buyer of a call, and in case if there is no movement, I'm expecting the markets to move in either direction. That's the reason I'm doing this strategy. And I go wrong, markets doesn't move in any of the direction. It stays at current levels where it is. So this is my dangerous zone, like 7800 to 8600. So in case if it expires exactly at 8200, then my loss would be the maximum, that is 400 rupees. Okay. At 8300, I will make a loss. I'll incur a loss of 300. At 8400, 200, 8500, 100, then 0, and then start profit. Similarly, 8100, my calls will become 0. However, my put will be 100 rupees. So 100 rupees would be my put ka premium. 400 I've spent less 100, so 300 would be the loss. At 8000, 400 I've spent, so 200 would be my put ka premium. So 200 would be my loss. At 7900, my put ka premium would be 300, my loss would be 100, and then at 7000 7800 I break even, and then I start making profit. So this is my danger zone, like 7800 to 8600. So this strategy can be done, long straddle can be done when I'm expecting the volatility to increase and the markets to move in either direction. That is when I should do this strategy. I'll explain you. Upper break-even points equal to strike plus net premium paid, lower break-even strike less net premium paid. Here it is. So upper break-even plus strike, so 8300, pay 100 rupees, 200, 300, and then break-even. So position loses value due to time theta decay in options. Because I'm a buyer of an option, I'm always exposed to this time theta decay. So this is long straddle. Usually at the money calls with same strike. This is most important, with same strike. This is called straddle. Now strangle. Strangle is the only difference between a straddle and a strangle, as I said, is straddle you do for same strike and strangle you do for different. When you do it, when you expect markets to move in either direction, that is the time when you do this long straddle strategy. This is and the major difference is because you are buying out of the money call and out of the money put. So the premiums, as I told you, like when I explained what is called, the outer you go, the far you go, lesser the premium for calls and puts. So you are, suppose if the current market price is say over here, you're buying 1140 ka call and probably you're buying 980 ka put. So you're going out of the money. That's the reason the premiums are lesser. So you spend less Rest all remains the same like a straddle. You are expecting the markets to move in either direction. Your view is that the volatility is going to increase, and that is when you do this strategy. So view on the market, very volatile. What needs to be done? Buy a call and a different and a put of different strike prices. Why different strike prices? Because when you buy out of the money call and out of the money put, the premiums are lesser. So that is why you buy this call and put. Strategy implementation, usually out of the money call and puts are bought with different strike prices. Upside potential unlimited, right? Every fall or every rise will your profits will start increasing. Over here, see 980. After 980, your profits will start increasing with every decrease in market. In case if you're a buyer of a call and a put, so every increase in stock, your profits will start increasing, right? So again, the risk that is attached to is option position loses value due to time theta that is attached to the options because you are a buyer of an option, right? So the only difference or the major difference between long straddle and a long strangle is long straddle is done for the same strike price, long strangle is done for different strike price. A short call. I'm bearish on the market. It is exactly to what is a long call. I'm expecting the markets to go up. Short call means I'm expecting the markets to come down. So I just go ahead and short a call option, right? So what is my view? My view is bearish on the market. What needs to be done? An investor is certain that the markets will not rise above certain levels and hence take a short position or a short call option. Strategy implementation. It is sold of X strike price. If an investor is less certain of his view, then OTM calls are sold, and if he is very certain, then ATM calls are sold. Now, suppose I'm very sure that the markets are going to go down, so I will go ahead and short probably 8700 ka call. Okay, so I will sell a call option of which strike price 87 ka strike price. Okay, and I get a premium.
All the messages in one email. We make 3-4 messages because nobody reads that long a message. So we'll make 3-4. One was which I sent a long message to yesterday or the day before. First one.
So I'm shorting 87 per call and I get a premium of say 50 rupees. Okay. So my break even on the upside is 87.50. That is my break even point. You can see my view is bearish on the market. So that's the reason I've taken a short position of 87 per call strike price. I get a premium of 50 rupees with. If suppose market falls to say 8400, still I will make a profit of 50 rupees. Why 50 rupees? Because by definition, again, it says when I'm a seller of an option, the maximum profit I will earn is the premium received. However, my losses are unlimited. Right. So 87 call, suppose if I shorted, I get a premium of 50 rupees. So this is my maximum profit. So I've given you different levels at 87, 8600, 8500, 8400. But my premium would be, the premium or the maximum profit can be 50 rupees. On the upside, my break even is say 8750. Above 8750, I will start making loss.
Forward to their friends.
So suppose if you are very bearish on the market, then probably you will sell at the money call. And suppose if you are mildly bearish, then probably you will go ahead and short out of the money call. And the moment you sell out of the money calls, the premium would be lesser. So in case if at the money call, that is 87 ka call is commanding say 50 rupees, your 87.50 ka call may command say 30 rupees, probably this would be 20 rupees, and this would be 89, probably say 15 rupees. So you feel that markets are not going to go above 8900, but it may go till 8900. Then probably you will sell 89 ka call and you get a premium of say 15 rupees. But suppose I'm very sure that the markets are going to go below 8700, then yes, you sell at the money calls. And So you sell at 87 ka call, you get premium of 50 rupees.
You read them. I mean, there are two messages.
Okay, so this is a naked call short. Please be advised that these short options should only and only be done with an advice of with an expert or a research team. I would personally advise that don't do a naked call or a short, because by definition, again, it comes with unlimited risk, plus it needs margin as well. In order to sell probably one lot of Nifty, you need approximately 1 lakh margin. This is approximately 1 lakh rupee margin. So, and it comes with unlimited risk. So please please, unless and until it is advised by someone, don't ever sell a call or a put option.
Here you add it.
Now, strategy, a call option is sold of X strike price. If an investor is less certain of this view, then OTM calls are sold, and is certain, then ATM calls are sold. Limited to the premium received. Upside potential is limited to the premium received. Market should expire at or below the strike sold. So in this case, I'm selling 87 ka call, then the market should expire either at 87 or below 87 to make this 50 rupees ka profit. Okay.
You are aware about the wrong.
My potential downside would be unlimited as market rise. So in case I'm shorting 87 ka call, with every incremental of 100 rupees after 87.50, my losses will start increasing, and this can go to whatever levels, like whatever levels the markets rise, my losses starts increasing. So that's the reason I'm saying that it should be done with experts' advice. It shouldn't be done a naked this thing.
You don't get confused. When you write about one.
My downside potential unlimited as market rise. If markets moves a little, then good potential to earn due to time theta decay. So seller of an option, they always they are at the benefit of this time theta decay. So also generally OTM calls are sold under this strategy.
Club has withdrawn.
Okay.
Then you write the email.
So I'm shorting the call. I'm expecting the markets to come down or like not go above that particular certain strike price. So that is when I short a call. At the same time, when I'm shorting a put, I'm not expecting the markets to fall below certain levels. So this is exactly to short. This is exactly opposite to shorting a call. I'll go ahead and short a put option.
There is a message from
again, put option, unless advised by someone, you should not do a shorting of an option, because this comes with an unlimited risk. Now, when I'm shorting an option, what is my view? My view is bullish, that I'm bullish on the market. So that's the reason I'm taking a short position on puts. What needs to be done? An investor is certain that the markets will not fall, but unsure it will rise, hence will short a put. That means mildly he is bullish. Not very, but he is mildly bullish. So that is when I will go ahead and short a put option. Put option is sold of X strike price. If an investor is less certain of his view, then OTM puts are sold, and if he is very certain, then ATM puts are sold. Right? So I feel that the markets are going to go up for sure. Then probably I'll sell at the money puts, and probably I'll sell out of the money puts. What is my profit potential? Limited to the premium received. Again, by definition, again, it says like when I'm a seller of an option, the maximum profit would be the premium received. So in this case, whatever premium I've received.
And one message of Kavita Kamraj.
So 87 ka put I've sold, I get 50 rupees. So the maximum profit can only be 50 rupees, irrespective of market going anywhere. However, my downside is unlimited. Downside risk is unlimited. On the downside, my break-even point is 8650. Below 8650, my losses starts increasing. So I'm selling a put. I'm expecting the markets to come up. That's the reason I'm selling a put. And markets go up, I'll make a profit of 50 rupees. In case if it falls, then my losses starts increasing.
So there you can see. Please refer the email here under. So that only that.
So downside potential unlimited at markets fall.
Date of the email.
If market moves a little, then good potential to earn due to time theta decay. Again, because I'm a seller of an option, I am liable for time theta decay. So
Yeah,
I
so you
am
can
at the benefit, but in case if market
now
moves
wherever
in
you
either direction, like then the losses can be huge.
holding,
So again,
there
in
should
order
be
to sell
subject.
a call or a put, you should be like you
Day
should take
by
an
day
advice
by
of
day
an
by
expert, and then only the strategy
but
should be
nobody,
done.
because if the subject is seen, withdrawal
So
of
if
countries,
market moves a little, then good potential to earn due to time theta decay. Also, generally OTM puts are sold under this strategy. Very high risk strategy, as potential downside is unlimited. Sold should not be executed unless advised by an expert. And one more thing, very important for an investor's point of view. In case if you have the stock in your portfolio, this is a very dangerous strategy to do in case if you are holding the stock. Okay,
are you
because what
able
will happen is, suppose if you have stock Reliance in your portfolio, or say TCS in your portfolio,
you have
and
to
use go ahead and short a put option of TCS strike price
message.
whatever. Okay,
First,
so
it has to be order
why
grammatically correct.
dangerous? Because in case if the
Whether
stock
TCS is
falls,
giving
you will incur
even
a loss in your stock as
whenever
well
you
as in the put option, because
need
put will
to highlight.
increase. Because you're shorting a
So you
put, you're
highlight
expecting the stock to
first
go
you
up.
you
On the
need
contrary, the
to
stock has come down, so you will
highlight
incur, like it would be
title
a double
and
loss. So you will incur
writing.
a loss in put as well
Message
and in your
below
stock as
top.
well. So this is a very dangerous
This
strategy for
here
the
is there.
people who have the
You can
stock
make a
in your
compartment.
portfolio, and against that you're
You have
shorting a
to
put.
write
So it's
the
advisable when you have the
title of
stock
that
in your portfolio, it's
particular
advisable that you
or
take a
price.
short call but not a short put.
Wait, I will
Okay.
do it and then I'll again send it to you and then you can incorporate. So
Again,
you don't
protective put.
about
This
both
is a
sides that
superb strategy if implemented properly, or for the people who are doing a naked
correct
future.
properly.
Trust me, guys, this is the
Wherever
this
I
is
have
the strategy which has to be implemented by everybody.
some of the words
Like
you will
whenever
not
I
be
take
able
these
to
classes, I hear
talk,
people
but
saying that I've
there
incurred huge losses in my future positions, and this is the specific reason that they incur huge losses. Trust me,
whenever you
when you
think
do this protective put, you will never ever complain with the
right,
market. You will never ever have a complaint in the market that I've
right,
incurred huge losses. Why? I'll explain you.
I have seen you are just
What is the
correcting it.
strategy? Hold stock and buy put option, either stock or future, whatever you are comfortable. Suppose if you're a trader and you trade in futures, then probably you will buy a future and you will buy a put option. Strategy
My
view,
text to
bearish. An investor holds the stock and is worried about the market fall.
the same.
Hence, he
Just
can
don't
buy a put option to protect the downside with upside is open in case market rises. Now, I'll explain you
I'm
exactly
sorry to tell
why
you, but
I'm
this is
doing
where I
this.
want it. Otherwise, don't. I mean, it has to be
Now,
look at very
protective put. Okay.
nice and nice later also.
Suppose, so at 120, no, I'll take an
Want to
example
change
of
some
you.
sentence, you want
It'll
to
be
change
better.
some wordings, you do it. It's not only for grammatical or spelling mistakes.
So 1800 is the current market price, and probably I will buy 1800 ka put option. My view is
Wherever
bullish.
you
That
want
means
to
I
just
am buyer of a future.
you
So
may change.
I'm expecting the futures to go
I'm
up.
okay.
That's the reason I will buy this
Okay, I mean, I
future
don't have
at current market price, which is
understood
1800.
what
And at the same time, what
know
I'm
the
doing is I'm buying a put option as well. I will
such
buy
person.
a
I mean, misuse
put
of the
option.
power that we have to
I
use.
spend say 30 rupees. Okay, so this is my position. I'm
I mean,
buyer
understood.
of a future at 1800,
Year one
and
and
I'm
this one.
buying a put option at the rate 30. Now what
On
will
Monday,
happen if suppose tomorrow due to whatever reason the stock
I
comes to
two
say,
assets, one of
okay,
the
let us say
two of the Harjeet, which has to be
1700.
incorporated, and one
Okay,
that Kavita Kandar's
so what
email
will
has to.
happen? Now the stock has, my view was bullish. That's the reason I've taken a long future. Okay, or
Based on
I've bought a stock again,
I mean,
and the stock falls by 100 rupees. What would be my loss? It would be minus 100.
there officially you
Simple.
can't talk. I mean, that's
But
misunderstood.
suppose I have bought a put option as
Just
against my 1800 ka position. I have bought a put option. So what will happen? The stock
I
has fallen. So my loss is 100. However, because I have bought a put option, that means I'm expecting the stock to come down, right? So the put value will increase. So at 1700, my put ka premium would be 100
I mean, Sudhir
rupees,
asked, okay, rest of them don't have
right?
anything to
So I have made a profit of
just
70 rupees.
who will ask you? Your Sunil, Here, why he has to? You said that this is a routine thing.
right?
I'm doing it.
So
I mean,
if you
so
can
much
see, my profit is 70 over here 100. So I've lost just
so you can tell
30
there is
rupees
some
in my position. So I can
so
literally sleep aram say by taking this position. Look, I've just spent 30 rupees. So whatever premium that I pay, that is my maximum loss. So this is the
you
specific
feel that
reason I'm
that is
saying that
not
whenever you trade in futures, you should be buying a put. So a simple thing would be when you're buying a future, you buy a put. When you sell a few, okay, I'll write over here. When you buy
then
a
do the way you want.
future,
It's okay. It's okay. It's
you
okay. It's
buy
perfect. But have
put,
I made my thing clear to
and
you?
when you sell
And
future,
wherever you think that you are not able
you
to uh,
buy
understand,
a
then you
call
don't
option.
get much to
See,
blame.
if you can do this now, trust me,
I
there'll be like the losses will always be curtailed to whatever you are buying the premium. Okay, so this can be your only loss in the future or a stock position. So this is like you buying an insurance against your futures. Okay,
you
so
said
if you
to me
can
that
do this, like
send you
make it as a
again.
ground rule that whenever you buy a future, you buy a put. When you sell a future, you buy a call option. Okay, the only risk is if the
But
stock doesn't move and stays at the current level,
one of
then the maximum loss would be the premium paid. However,
like
you will
these are
always
all
and always be protected against your futures or stock positions. So this is the
anything
best
which
strategy to be implemented: protective put or a
yes,
protective call, you can say. Okay,
that's why
so the
I'm
strategy
writing.
is
But
hold
I was
stock and
part of
buy put option. Bearish,
I
an
was the
investor
only
holds the
person who
stock
was
and is worried about the market fall. Hence, he can buy a put option to protect the downside with
this one I'm
upside
objective
is
way you
open
are
in
not
the in case
without
market
this.
rises. Strategy implementation:
So
put options are bought with X
so these
strike price, generally 80M. The
now
number of
we
put option bought depends on the size of the portfolio. So if
this
the
point.
if suppose
We
if you
have
have
to
250 Reliance in your portfolio, and then you
as
can buy one lot because Reliance the lot size
most
is say 250, then you can
yeah,
buy one lot. So this should be equivalent to
I know
your portfolio number of stock, like
some points they
portfolio
should
number.
people like making
Upside potential is again the
the
maximum
number
loss can be only the premium paid.
that
However,
you
your break even, suppose at 8 after
you can make little
1800 and you bought put
paragraph.
option by spending 30, your break even on the
But
upside
I
would be
don't say yes to
1830,
the and
and
don't write whatever way I write. Otherwise, so may
so the
लिख
stock goes to say 1900 rupees.
So your wisdom
So
is
still you will make 70 rupees in the
it is not
position.
very
Why 70 rupees? This would be like 90 at 1900.
polished way. That is the difference.
This minus this. So this is
Oh, it
100, but you have spent 30 rupees. So 70 rupees would be your net profit. With
since
every incremental of 100 rupees, you will again start making profit. However, on the downside, your downside is protected to only 30 rupees. So this
I
is the
have
specific reason it's always advisable you do a protective put or a protective call strategy, right? So downside potential limited to
so
the
far I
premium
was
paid. See here, limited to
but
the
now I
premium
think
paid.
I should
Break even point
not
underline of
minus
the stock less premium paid. So over here, upside break even would be 1830. Above 1830, you will start incurring profit.
so let others also have the pain
This
what
strategy
pain.
can be done to protect the portfolio and can also be done to trade in futures, buy
But
put.
I don't worry now what my image
Buy
will be.
futures,
What
buy put, sell future, buy a call option.
otherwise also my image has been I mean tarnished. So why I should
A
worry?
bear
What
spread.
I have nothing to lose. Those who
This is
know me,
again a
they will
very
like me.
commonly
Those
used
who
spread
don't like me, they don't like. It's okay with me.
in
I
today's
have nothing
market.
to
Now,
because
mind you, in order to sell one nifty lot,
I'm
you need
ready to hire.
approximately 1 lakh the margin. Now, with exchange from 1st of June, what exchange says that in case if you do a strategy, then the margins fall drastically, and that is approximately one fourth. So, suppose if you want to sell one lot of,
And he knows that
you need
Ravindran also.
approximately 1 lakh.
And
Okay,
so they are all
this
going
is
together.
naked short,
I have written in one message. You must have read
right?
yes or
But
day before.
now with
Where one
this
person told me,
bear put,
"Oh,
what needs
I
to be
bought."
done is you need to buy a
I
put
mean,
option
yeah, he
and you
bought.
sell a put option.
I thought
So
he
this
maybe
is
just
what
give
your
me
bear
this,
put is. Okay, you buy a put
but
and you
no,
sell a
I
put.
like the way he
Okay,
planned it. Now I
so
think of it.
suppose if you
So
buy a put and you spend a premium of say 50 rupees,
I mean, they had
and you
planned
sell
this
a
way.
put, you get a premium of 20 rupees. So your net loss will always be defined to the difference between buy and sell. So the net loss will always be 30 rupees.
So he
Right?
needs this.
So when do you do this strategy? I'll tell you what needs to be done and when you need to do this strategy. An investor is certain that the markets will fall and buy puts of higher strike and sell puts of lower strike. Strategy implementation.
He knows each and every. Even
Put option of X strike is bought and put option of Y is sold, creating a net debit. So there is always an outflow. Now, like I'll show you over here. Long put, you bought 150 ka strike at the rate 16 and you short 120 ka put at the rate 5. Okay, so 150 ka put you're buying and you're shorting 120 and you get a premium of 5 rupees. So the maximum loss in this position can only be 11 rupees. And the maximum profit zone would be always be your sold option. So whatever levels you have sold, that is your maximum profit zone. Okay. So 50 rupees I'm buying and I'm selling 120 ka put option. So this is the maximum profit zone. You can see
less than
19 rupees. Okay. So the maximum loss I will incur is 11 rupees. However, my profits would be 19 rupees. So irrespective, my view is bearish. That's the reason I do a bear put spread. Why do I do a bear put spread? Because in order to, because I'm certain that the markets are going to fall, but I don't want to pay high premium. So that's the reason I sell a put at the same time. So I buy a put. That means I'm expecting the markets to come down, but I don't expect the markets to fall below a certain level. So that level I will sell a put option and I will try to bring my cost down of the put option.
All those things happen.
So my maximum profit zone would be 120. My maximum loss in case I'm buying a put option of 150. If I go wrong and markets rises, then my maximum loss can only be 11 rupees. However, my profits will only be 19 rupees. What is my maximum profit zone? 120. Whatever strike I have sold, that is my maximum profit zone. Okay. Yeah. When to use when an investor is moderately bearish or on markets and think that the markets are more likely to fall than rise. Limited difference between strike less initial debit. There is always a net debit that happens because I'm a buyer of at the money put and I'm selling out of the money put. So always out of the money puts commands higher premium or at the money options commands higher premium. So that's the reason there will be a net debit that will happen. So the debit in this case is 11 rupees. 16 minus 5, that is 11. So 11 is the net debit and the maximum loss can be 11 because that's what I have paid. That is my outflow and my maximum profit can be 19.
Yeah, that's
Limited if the expiry is above the strike price, break-even point, strike of a long put less net debit. Time value theta not much significant, as it would be little bit significant because I'm buying at the money put option, but not much significant because I'm buying and selling a put as well.
Here, according to me, still you can add something to make it more clear.
Short straddle is exactly reverse to what is long straddle. So I'm not expecting the markets to move in either direction. So I will go ahead and short 89 ka call and put. So the maximum profit zone is 400. In case if I'm shorting 89 ka call and I get a premium of 400 rupees cumulatively. In case if the market expires exactly at 8900, then the profits would be 400. At 9,000, I've given you different levels. At 9,000, my profit would be 300. Why 300? Because this would be like 100 rupees call premium would be 100 rupees, put will become 0. So 300, 200 on the upside break even would be 89 plus 400. That is 9,300. That is my break even point on the upside. And on the downside, it would be 8,500. So this is the range in case if the market expires in this big range, then I'm likely to make profits. However, if the market moves in either direction, then I will lose. So this strategy is done when you don't expect markets to move big time and you expect the volatility to dry up, that is the time when you do this strategy, short strategy.
Okay.
Neutral
I read
with less volatility. What needs to
and
be
we were
done?
talking
Sell,
about,
call, and put of same strike. Again,
but
straddle, so same strike.
what is
Strategy
the
implementation, call and put of same strike is sold, creating a net credit. When an investor feels that the markets will not move in either direction, then probably he will take a short straddle. Limited to the premium received. Upside potential is limited. Max profit is if market expires at sold strike price. So if in case the market expires exactly at 8,900, then yes, this is my maximum profit zone.
The other one doesn't have a chart. They don't want to have.
Downside potential unlimited in case if the market moves in either direction big time. If suppose you're not expecting markets to move and markets move in either direction, then yes, the losses can be unlimited because you are a seller of an option. So you can see if above 9,300, with every increase in the market, my losses starts increasing by 100 rupees, and on the downside, with every fall in of 100 rupees, my losses starts increasing by 100 rupees. So this is a range bound strategy wherein I'm expecting the markets to expire in between these range. So in case if the markets expire in this range, then I'll make a profit.
I had my business. You have so many things.
So note, a seller gets maximum benefit of time theta.
Something goes wrong with me today. So there is nobody to
So
understand
this
what
is
is
short
my
straddle, and short strangle would be I've
everything is
not done this, but short strangle would be I'm selling probably two different strike prices. Say probably I'm selling say 9,500.
having girl and having a boy is not in our hand, but life becomes incomplete. That's what I mean. You have your daughter-in-law, you have your grandchildren. Life continues.
So what is short strangle? Strangle would be I'm selling different strike prices. So probably I short this call and
Now,
probably I'll short this put.
I can see all the boys in my family, my
And suppose
friends.
I get a premium of say 50 rupees. Over here I get a premium of 50 rupees. Okay.
There's profit
So
everywhere.
I think that the when this strategy needs to be done, when I feel that the markets is going to stay in the range of 9,400 to 8,200. This is the big range in which the markets are going to stay in. So I will go ahead and short this call and this put.
And I will know 10 people and who would be very happy to do something for me.
Okay.
In
So I
any
will go
given
ahead and short 94 per call. I will short 8,200 per put. I'll get a premium of 100 rupees. So on the upside, my break-even point would be 9,500. This is my break-even point. And on the downside, my break-even point would be
so many others.
8,100. That is my.
And I have been trained to all. This is the first time they have
So
done
in
the
case
mistake.
if the market stays in this range, big range of 8,200 to 9,400, I will make a profit of 50 plus 50 because of the time theta decay. So this is the range wherein I get 100 rupees. Above this range, in case if markets moves above 8,100, with every fall in the market, my losses will increase by 100 rupees. With every increase of this after 9,500, my losses will start increasing by 100 rupees.
It's not their done. I mean, whatever Harjeet done, whatever Raju done,
Neutral
they
with
were
less volatility, both needs to be done. Sell, call, and put of different strike price. Strategy implementation, call and put of different strike prices sold, creating a net credit. So when you sell a call and a put, there is a net credit that happens, and because you are a seller of an option, you are liable for maximum loss, right? When to use when an investor feels that the markets will not move much and it will trade in a very small range, or like if the investor feels that the market is going to move in this range like 94 to 8,200, then yes, then you can do this strategy. Limited to the premium received, maximum profit potential is like 100 rupees.
When I was a government.
Downside potential can be unlimited because you are a seller of an option. In case if market moves in either direction, then the losses can be huge. So that's the reason I said whenever you want to sell an option, be it call, put, a straddle, or a strangle, it should be backed by an expert.
He was how should I put it? He was like a Daisy.
So note, a seller gets maximum benefit of time theta decay.
Yeah.
right?
Vikram
In
Sona
case if it expires anywhere or it doesn't move, then this 50 rupees will start decreasing by say 20 with every passage of day. This premium
but
will
I mean,
start
the chairman
decaying.
is talking chair. I'm the chairman. Why did he allow him?
So yeah, thank you guys, and that's about it. And any questions, please let me know.
This
Like I'm
question
open
highlights this.
for
This has to
questions.
be highlighted that why Vikram Sona was allowed to be seat, allowed to win the DCB. Some of the points we have to highlight, which makes the things clear. You have now read the complete message now. So suppose you have to read it again. I mean, you receive this message from someone, so you should be able to read few lines and the things will be clear to you. That kind of thing. Then I will give you some 100 out of 100 marks.
Hello, Aisha.
We see that we give you something extra. So we will make a threesome, na? So हो जाएगा. Hello.
So I have one question: is trading in derivatives a better, safer option than equity trading? So it totally depends on your appetite. In case you
Sir,
feel
मैं बात करता हूँ.
in case if you have very less this thing
But
money,
I
then probably you can
always
trade in
something
options.
that will be compulsory.
And in case if you want to hedge your positions, then yes, options is a better tool. So it can be used as a hedging tool as well. So yeah, when I buy a call, I pay premium of say 10,000, say rupees 10,000. If my portfolio shows 2,000 as profit, can I book that 2,000 as profit? Yes, you can book your profits as well. At any time, you can square off your positions in options. As you mentioned that we can play on a call of Reliance 1800 and I'm holding 500 shares, then how call to be taken? As you mentioned, sorry. I didn't get this question. As you mentioned that we can play on a call of 1800, I'm holding 500 shares, then how call can be taken? Please. So if in case if you're holding say 250 shares in your portfolio, then you can go ahead and short probably out of the money call options, uh, which like I'll just help you how to select the strike price. The thing is, in case if you feel that probably say 2000 is the level where I'm comfortable to sell my stock, then probably you will go ahead and sell probably to 2000 ka strike price ka call. So basically your target price ka strike price ka call, ideally you will go ahead and short. And in case if markets stay at those so stay below at those levels, then probably you will make a profit. You will just fetch those premium. One important question: how do you place hedged orders simultaneously to avail lower margins? uh, you just go ahead and buy a call option and you sell out of the money call option. Once you do this, your margins will come down immediately. So as I told you, probably you want to if you want to sell one lot of Nifty, you need approximately 1 lakh per margin. But the moment you buy probably at the money call or little out of the money call and you sell out of the money calls, then the margins will get adjusted and you will get margin benefit, and that is how you can place an order with lower margins. So first you need to buy a call and then probably sell a call, and at the same time if you're expecting the markets to come down, you will buy at the money or just like two strike lower the put, and at lower strike you can sell. So first you need to buy and then sell, and that is how you get a margin benefit against your the same. That is how you can avail lower margin benefit. This is very important. Are there any agencies who deal FNO on our behalf if we pay, say, 5-10 lakhs for 1 or 3 months? I am not aware of such an agency, so I'm sorry about that. There is one interesting question. Why should I hold futures when I'm bearish on the stock index? If it is a long position on a stock, then can buy a put for short term. But futures are also not really a long term. How can we use both bullish and bearish on short term at the same time? This is Yeah, that's what I said. This is a protective strategy wherein you buy a future and at the same time you buy a put so that your downside is limited, but your upside is still open to the like your losses can only be the premium paid. Getting confused about short term can be for different people, different this thing. But in futures, like generally, as I told you, like 3 months contracts are available, so there are always short term players in the market. What will happen if the options are not squared off before expiry? Okay, now with new rule, not new, but probably 8 or 9 months back, exchange told that all the in the money options are liable for physical settlement. However, your out of the money options are not liable for physical settlement. So in case if the stocks are like if the options are out of the money, you don't need to worry, you don't need to do anything. But in case if you want, if the options or if you have options which are in the money, then yes, you are liable for physical settlement. In case if it's a buy position, then you'll have to you'll have to you'll have to buy the stocks. In case if you're a short and the option expires in the money, then you'll have to give the delivery basically. So it's very important for in the money options. You need to square off your positions on or before last Thursday of every month, and all the future positions are liable for physical settlement. Is it better to trade in options at the beginning of the month since you get more time? So it totally depends whether you are taking a short position or a long position. It totally depends. But yes, in case if you're doing a covered call like against your portfolio, as I told you, then it's better you do it at the beginning of the month because the premiums are like very the premiums are very high. So yes, if you're doing a covered call, then yes, it should be done at the beginning of the month. Else, it totally depends which strategy you are taking. So it totally depends on that. When I buy a call, I pay a premium. My port. No, this is already I've answered. I think we are done with the questions, and yeah, I think that's about it. Thank you all for attending, and we will keep such seminars in future as well, which will help you enhance your trading this thing, and which will help you to trade more. Okay, so thank you guys.